If you're anything like 99% of people trying to trade order blocks, then your trades probably look something like this. Everything looks great. You've got an order block set up, you get tagged into your entry, everything looks like it's going well. And then out of nowhere, for no reason known to you, you just get stopped out. So that's an issue you're facing, and in this video I'm going to be sharing how to actually find profitable order blocks that work. In this video I'm going to be sharing 4 key things. Number 1, what is an order block? Number 2, how to identify an order block. Number 3, what are the 3 things that I look for when hand selecting an order block? And finally, number 4, I'm going to be sharing with you the exact step-by-step strategy that I personally use on a consistent basis that is proven profitable. Without further ado, let's go ahead and get into it. An order block is essentially an area of price where there are large resting orders waiting to be triggered. And so when you see price trade into these areas, into these order blocks, you will be expecting to have some reaction out of that order block. Now, the key is in selecting the correct order blocks. Okay, so how do we actually identify an order block? Here's what you want to be looking for. Essentially, you want to find, number 1, the first thing is, where do you see a large amount of volume kick into the market? Essentially, that can be identified as a very aggressive candle either in one direction or the other. So for this example of identifying a bullish order block, we can see that we have this aggressive bullish candle that moves to the upside. From there on out, what you want to be identifying is this final candle just before that impulsive move, right? We call this the sell to buy candle. This is what is going to be characterized as your order block. It's essentially the area of price that first sells into the buy, and then we have the aggressive move out of it. Now, to identify this, your order block should always have a fair value gap, ultimately an area of imbalance. What we can see here is this first candle right here, followed by the second impulsive bullish candle right here, and then we have one more bearish candle. Now, the key here is to notice that the first candle, that wick, the highest wick of the first candle right in here, does not meet with the third wick, right? So we have 1 candle, 2 candles, 3 candles. This wick does not meet this wick, and that leaves a gap, right? A fair value gap. If you can notice a fair value gap, then the likelihood is there is an order block somewhere around that level. And how you identify that is you just want to use the final down candle before that up candle in a bullish order block scenario. Or what you can do is, if you want to identify a bearish order block, essentially what you want to be looking for is the final buy before you have the aggressive sell candle. But remember, the candles of the first and third must not meet. In this scenario right here, you can see very clearly that this first candle and this candle right here, they both touch each other. Therefore, that does not give you a fair value gap. Therefore, that does not give you a bearish order block. So if we can just continue playing the price out, what you will notice is we have a buy candle in here, right? And then we have a sell candle, then we have another sell candle, and then we have a third sell candle. Now, again, we want to be identifying this candle right here and this candle right here. That is essentially your fair value gap. And wherever there is a fair value gap, there is going to be an order block in there somewhere. And so how we want to identify that is just looking at the final buy to sell candle that forms just before that aggressive momentum. And what you can do is you can use the bottom wick of this and the top wick of this, and that will create your bearish order block. Okay, so here are my 3 rules that I go to when I'm trying to mark out high probability order blocks. So rule number 1, and arguably the most important rule, is you must be pro trend. Time and time again, traders are trying to trade bearish order blocks when the order flow is bullish. It makes no sense. So make sure that you have this external swing structure aligned like this, and you can see that price makes low, high, higher low, meaning this low here is higher than the previous low, and then we have a higher high. So at that point, it's already indicated that price is bullish. We have this bullish breakup structure like so, and then price is going to respect this area in here, and I can guarantee you there is some type of order block inside of here that price then is able to react from. So that is number one. Make sure you are pro trend. Number two is you want to wait for some sort of run on liquidity from that sell to buy level. So what we can see here is we have this bullish structure, and then as price pulls back, you can see it puts these internal lows in. Now notice that this final sell right here, this final sell to buy actually causes a run on liquidity. So we actually run on the lows in here, right? So we have a liquidation in here. So you want to see a run on some sort of liquidity before that order block is formed. And then don't forget, make sure that this order block, this sell to buy, has a fair value gap from candle 1 to candle 3. There's your fair value gap. Great. Now you know how to identify your order block. Now, final one, and my golden rule number 3, is make sure that that order block was something that led to a break of structure. That order block itself doesn't have to break structure, but there has to be a break of structure in that price leg. For example, what we see right here is now we are bullish, right? We have our swing low down here, and we have our swing high up in this region. So as long as we stay inside of that price leg, this order block is valid. But if we do something like this, for example, let's say we now pulled back like this, and then we went and did higher high, and we had a new break of structure, well, this order block no longer becomes valid. What we'd actually be then looking at is probably some sort of sell to buy inside of this price leg in here that leads to a break of structure. So make sure that the break of structure has a order block inside of. Make sure the order block you're looking for has a break of structure inside of it. So from there, those are 3 rules on how to identify the order block. And if you have something like this, where you have a pro trend move, right? We have higher highs, higher lows, higher highs. Price pulls back, gives a run on liquidity, this bearish sell to then buy, gives the engulfing candle, and then breaks some sort of structure. That is a high probability area for price to then be able to come back to something like this before putting in some sort of high high. And this is exactly where you would trade from. So let's take a look at what this order block scenario looks like in the markets themselves. Here we are. And what we can see right here is the price is bullish. So step number 1 is, where is your directional bias? You can see we had this low in here, puts in a high, price pulls back, right? Respects what? Respects the previous bullish order block that we were talking about. And then what does price do? Price then has this aggressive move out of this price range, breaks structure, right? We have a break of structure to the upside like this. So there we have our pro trend. We're trading with the trend. We have our break of structure that was come from this bullish order block in here. And then finally, what else do we have? We have our run on liquidity, right? You can very clearly see that we have an old low in here. Then we have this final sell into this liquidity, relative equal lows, sell into liquidity, and then aggressive buy out. So we've ticked all 3 boxes. We're pro trend, right? We're clearly in a bullish trend. We have taken a run on liquidity, and then we've broken structure. So that means that our order block is inside of the structural price leg that we're currently trading inside of, our current trading range. Then what you can do is you can map out your area of order block, your bullish order block, and then you can just wait and see how price reacts. So you can see price has a reaction, a bullish reaction, drops down deeper to mitigate, and then begins aggressively advancing out of that level and takes out the continuation, right? Another break of structure, just continuing in the overall trend that price is currently trading in. Now we're going to take everything that we've just learned about the basics of order blocks, and we're going to apply that into my step-by-step profitable order block trading strategy. I'm going to give you an exact rundown of a trade that I took using the exact strategy that I'm going to be sharing with you. Okay, so now let's walk through this trade on Euro US dollar during London session. So first thing I'm going to do is I'm going to switch on my session indicator. This allows me to outline the exact sessions, so you know that this is during the London session. Now, step number one is we need to identify what is the trend direction. And so you can very clearly see that price was aggressively bearish. We put in a lower low, a lower high, a lower low, giving us a break of structure to the downside, followed then by a change of character. So you can see we've changed the trend here. We were indeed bearish, putting in a series of lower lows, and then we've put in a higher high, meaning this high that we've just placed in here is higher than the previous high. Therefore, we have now shifted bullish. So we no longer want to be looking at any bearish order blocks, or anything of that nature. We want to be paying attention to the present moment trend, right? So we want to make sure that we are trading inside of this trading range. So our bias is indeed bullish. We are looking to take long positions. Now, step number two is I need to find an order block that makes sense to trade from, right? And this is going to be my point of interest, my higher time frame point of interest, right? So what we want to be looking at is this particular session in here. This is Asia in this blue box from here. It's from 8 till midnight EST. This represents the Asia session range. Now, as you guys know, the highs and the lows of this Asia session range are extremely liquid. So what we want to see is coming into our London session, we want to have a clear directional bias, which I have. I am bullish. I want to have a clear point of interest below Asia session low. If I'm buying, I want to be buying below that Asia session low, right? So where in here can you see that we have a clear area of order block? Well, you can see very clearly in here, right? This final sell to buy candle that has a fair value gap. You can see the first candle in here does not meet with the third candle in here. That is our clear and obvious fair value gap. You can see that it runs an area of liquidity, right? So the final sell runs the previous candle's low, which is a run of liquidity. And then we have this aggressive push out. It's inside of the area. It's inside of the pro trend move, right? We've already had our break of structure. This order block is inside of that break of structure price leg. And what we want to see is price pull back, liquidate Asia low, drop into here. And then when I get into this area, I don't want to just take a risk entry on here, right? And besides, even if I was to take an entry on here and target our target, which is our Asia session high, that's going to give me 3.3 risk to reward, which might seem decent to a lot of you guys, but some of you who know and have been around here for a long time, you know that my minimum risk to reward is 1 to 5, right? So what I want to do is I want to get into this area, then I want to drop down to the 1 minute time frame, and then I want to take my entry there. So let's see how that plays out. First thing is waiting for price to get into this area. And there is the objective complete, right? We have equal lows in here. We have Asia low in here, which is a prime area for a sweep on liquidity. We've now run the liquidity. We have our point of interest. We are pro trend looking for buys. Time for our entry confirmation. So what we're going to do is we're going to drop down to the 1 minute time frame. And now we need to establish what is our directional trend at the moment. So you can quite clearly see that we are bearish, right? We're in this heavy downtrend, and we can see that this was our swing low. Price pulled up, swing high, then we went lower low, right? Lower low, lower high, and what you can just notice, price has just what? Run on liquidity. This low that was supporting this bullish move up has now been liquidated. So what we would need to see is a realignment, a market structure shift above this high, displacing this high, and then that would be our confirmation that the 1 minute time frame is now ready to go in the same direction as that 30-minute time frame. So if we just play price out, there is your displacement, right? There's your market structure shift and your displacement. Price is putting in a series of lower lows, lower highs, liquidation of the low, run of the high, giving us a realignment, displacing above the previous high. And now what do we want to see? we want to see an area of demand. We want to see a bullish order block. So what do we need to see? Well, we need to see this move right here, this sell to buy that breaks structure that's coming from our higher time frame point of interest, that has taken an area of liquidity, right? Any low or any high in an opposite example is a run of liquidity. But not only is this a run of liquidity, this down here is also a key run on liquidity. So we had a run on liquidity here, price pushes up, reacts to this bearish order block, pushes down, and then buyers outweigh the market, giving us a sell that liquidates price and then breaks structure to the upside. Now we just want to look at this as our bullish order block. You can see it has fair value gap. Candle 1, candle 3 doesn't meet. We have a fair value gap. That is where we want to look at taking our position from. We want to put our stop loss below this low in here. And I know what you're thinking. That is a pretty tight stop loss. And it is. So let's continue and see where are we going to take this trade to. Well, we want to always be trading in alignment with the trend. So if we know that we're bullish, we want to just take price to the next logical high that makes sense. So we want to go for a minimum of 1 to 5, right? So there's our 1 to 5. There is our displacement. Now it's time to enter. And this is where we're going to be entering from. So price continues trading higher. Price ranges. Okay, price is now at this point creating what? Creating a range. What do we understand about ranges in price? A range in price is creating liquidity on both sides of the market. So when you see a range occur like this, that is ultimately building liquidity on the buy side and on the sell side. And what you'll see a lot of times happen is you'll see a run first on the buy side liquidity, inducing all of these buyers. Everybody is now looking to buy because everybody is perceiving this as a breakout. And then price runs the actual liquidity that it wants to run and then goes into the direction that it really wants to trade into. So pay attention for that schematic right there when we break this down, right? What do we see? We have equal highs across here. Okay. Price runs the equal highs. What do we have across here? We have relatively equal lows. So price has now run the buy side of the liquidity. Okay. Now it's created what? More equal lows across here, stacked lows, equal lows here, lows here. Again, running buy side liquidity. So this trade becomes invalid if we break this high. If we hit the take profit before we have been tagged in, obviously this trade then becomes obsolete. There's no need to take it anymore. However, if it doesn't, then we still trade it as is. So there you can see there is the aggressive liquidation of this low in here. There's your liquidation. So at this point, price may or may not tag you in. Again, just keeping the order open. So price does tag in, and if for whatever reason you would have removed your order, then you can pay attention to the details by reconfirming this area of price. Because what do we notice in here? Well, you can see as price pushes up, right, and then breaks structure, these tiny little swing points are dictating the order flow. And so you can see that price is printing this lower internal trend, right? Even again, you can see it's printing this lower internal trend. We have low, high, lower low, lower high, lower low, lower high, liquidation. And then what do we have? It's the exact same thing over and over and over again, right? So we have had no break of structure yet. So we would need to see some sort of break of structure. But there, when you have your break of structure, what do you now have, right? Again, price, I'm going to zoom in to pay attention to detail, right? Again, these are the little details that people overlook. What do we see? We see that price is printing lower lows, lower highs, lower lows, lower highs, lower lows, liquidation, higher high, right? There is our order block, our bullish order block that breaks structure. Number one, it breaks structure, it liquidates, and it's aligned with the overall trend. So if for whatever reason you wasn't able to capitalize on the original move, you can put another position in. I would cover the same stop, right? So it stops on this same low in here, just in case it does want to come a little bit deeper. And then where do you target? You're just looking at the exact same area because the bias is to take price into this area. So that's a 1 to 6.85, and then keep playing price out. So price aggressively moves out of this level, and then eventually price runs to full take profit with 2 potential profitable positions, one for 1 to 5 risk to reward and 1 to 6.85 risk to reward.